Most people think the only way to invest is through the stock market. You buy shares of public companies, maybe a mutual fund or ETF, and hope the investments grow over time. But here's what many people don't realize. Some of the largest investors in the world allocate significant portions of their portfolio to investments that never trade on the stock market at all. Private companies, private real estate, private equity, and other alternative investments. Now, that doesn't automatically make them better. Every investment has risks, and private investments often carry additional risks like illiquidity, higher minimums, and greater complexity. But if you've ever wondered why institutional investors and many high net worth individuals spend so much time looking at private opportunities, keep watching. Because today we're going to look at how accredited investors are able to access private deals, what those opportunities actually are, and what you should understand before deciding whether they're worth exploring. And if while watching this video, you decide you'd like help determining whether private investments make sense for your financial situation, you could schedule a conversation using the link below. We'll help you understand what's available, explain the risks, and determine whether these type of investments fit into your overall strategy. So let's begin with the biggest misconception. Many people believe private investing is reserved exclusively for billionaires or massive institutions. That certainly used to be closer to the truth. Years ago, opportunities in private markets were often available only through personal relationships or institutional connections. Today, while many private investments are still limited, qualified investors have access to a much wider range of opportunities than they did in the past. So who qualifies? In the United States, many private security offerings are available only to accredited investors. Accredited investor status generally depends on meeting certain financial qualifications established under securities regulations. These may include income thresholds, net worth requirements, excluding a primary residence, or certain professional certifications. The exact rules can change over time, so it's important to verify current eligibility requirements before investing. Why do these rules exist? Because private investments often involve greater complexity and different risks than publicly traded investments. Unlike publicly listed companies that must meet extensive reporting requirements, many private offerings provide less publicly available information. Investors are expected to perform more due diligence and understand the risks that they're taking. That's one reason these investments aren't appropriate for everyone. Now, here's where things get interesting. People often hear private investments and imagine it's just buying stocks or startups. But in private markets, it's much broader. For example, some investors participate in private real estate projects. Others invest in private credit strategies that provide financing to businesses. Some gain exposure to private equity funds that invest in established companies. Others may invest through special purpose vehicles, often called SPVs, that allow multiple investors to participate in a specific private opportunity. There are also investments involving infrastructure, energy, venture capital, and many other specialized asset classes. Each one has different objectives, risk profiles, time horizons, and liquidity characteristics. That's why simply saying I'm interested in private investing isn't enough. The better question is, which type of private investment actually aligns with your goals? Here's an example. Imagine two investors. One is looking for long-term growth and is comfortable locking money up for several years. The other wants regular income and expects to access their capital if needed. Those two investors may be completely unsuitable for the same private investment. That's why understanding your objectives comes first. The investment should fit into your plan, not the other way around. Another important difference between public and private investments is liquidity. When you own shares of a publicly traded company, you can generally sell them during market hours. Private investments often don't work that way. Some investments may have longer holder periods lasting even several years or indefinitely. Others may have very limited opportunities to sell before the investment reaches its planned exit. That's neither good nor bad, it's simply different. And investors need to understand the difference before committing capital. Another misconception is that private investments are always higher risk. The reality is much more nuanced. Some private investments involve substantial risk and are highly speculative. Others focus on established businesses or income-producing assets. Risk depends on the individual investment, the structure, the manager, the underlying assets, the leverage they use, market conditions, and many other factors. There is no single risk profile that applies to fit every private investment. Which brings us to our most important concept. Due diligence. Successful private investors rarely make decisions based solely on exciting marketing materials. Instead, they ask questions. Who manages the investment? What's their experience? How is the investment structured? How does the manager get paid? What assumptions can be made on the product? What happens if conditions change? What's my biggest risk? How long is the expected holding period? Those questions often matter far more than projected returns. Because in private markets, understanding the downside is every bit as important as understanding the upside. Another thing many experienced investors focus on is diversification. Even if someone qualifies as an accredited investor, that doesn't necessarily mean every dollar should go into private investments. Many investors use private opportunities as one component of a broader portfolio that may also include public equities, bonds, cash, and other investments. The goal isn't necessarily replacing traditional investments, it's understanding whether private markets may complement an overall investment strategy based on individual objectives, risk tolerance, liquidity needs, and time horizon. Now, you may be wondering, how do accredited investors actually find these opportunities? Sometimes it's through financial advisors who work with qualified investors. Sometimes it's through private investment platforms or fund managers. Sometimes it's through professionals at work. And sometimes it's just through sponsors raising capital for a specific opportunity. But regardless of where an opportunity comes from, the process shouldn't begin with asking, how much can I make? It should begin with, does this investment fit into my financial plan? Does it align with my goals? And do I understand the risks? Can I afford to have this money invested for that expected time period? Those questions can prevent a lot of costly mistakes. If you're enjoying the video so far, and you'd like to learn more about how accredited investors evaluate private opportunities as part of a diversified portfolio, schedule a conversation using the link in the description below this video. We'll walk you through the different types of private investments, explain how they work, discuss the risks involved, and help determine whether they might be appropriate for your situation. Because education should always come before investing. The bottom line is this: private markets have grown significantly over the past several decades. Today, accredited investors have access to opportunities that simply weren't available to many individuals years ago. But access alone isn't an investment strategy. Understanding what you're investing is. Private investments can offer different characteristics than traditional public investments, but they also come with unique risks, including limited liquidity, manager risk, valuation uncertainty, and the potential loss of principal. That's why the best investors don't choose every opportunity they see. They evaluate each one carefully. They ask questions. They understand what they own, and they make investment decisions that fit within a comprehensive financial plan. If you'd like help understanding whether private investments deserve a place in your portfolio, we'd be happy to have that conversation. Use the link below to schedule a call. We'll discuss your goals, answer your questions, explain how different private investment structures work, and help you determine whether these opportunities align with your financial objectives. Thanks for watching, and we'll see you in the next video.